Okay, I record this video on Saturday, the 21st of October, 2017. Do hope you are doing well. So finally, Thursday and Friday, that was a bit more like it, wasn't it? We had a really interesting start to Thursday. The sell-off in the Asian markets, I think they kicked off in Hong Kong, kind of going down, and then translated into a massive reversal on Thursday that continued overnight and into Friday with absolute new highs. Just extraordinary. Great trading. Hope everybody kind of got on board those moves and enjoyed it. But I must admit it was preceded by 5 or 6 days. I think it was about 6 days of just absolutely nothing going on. This is my range indicator here, and the yellow bars show low range. And what were we down to? This would have been Wednesday, 4.75 points top to bottom, and it's just tough trading. The only way to trade days like that is not to bother. Identify it's a slow day and it's going to be a low range day, and just kick out and get out as quickly as possible and not to trade. Keep your losses to an absolute minimum, because then when days like Thursday and Friday kind of pop up, bang, it's where you make it all back and more. Anyway, so not going to talk about the E-mini trades in this video. Maybe I'll tag on my Friday day trade because it was an interesting one later on. But I want to talk about something more interesting that's happening, and I think it's important. It's the bond market and interest rates. And is it seminal? It could be. You know, you never know in kind of retrospect. But I think this change in interest rates and the bond market has been bubbling up for about 4 years, really. And I think now we've got some really interesting kind of patterns and trades starting to shape up. So now this looks pretty crappy on a small screen, I must admit, but on a big screen it looks great. It's the interest rates for the 5-year, 10-year and 30-year bonds and notes and bills, and daily, weekly and monthly charts across here. So across the top is the 5-year, the 10-year in the middle and the 30-year at the bottom. Just concentrate on one little thing and I'll blow one of these charts up. First of all, we're above on the daily charts, above resistance. That means breaking into an uptrend. Above resistance, breaking into uptrend, and actually pull back in an uptrend on the 30-year here. On the weekly charts, we're above support. We're above support. We're above support. And on the monthly charts, we've had a little bit of a reaction against a resistance on the monthly, and we've come back up and we're about to jump across that resistance. Closer, pretty close on the 5-year, 10-year a little bit further away, and the same kind of pattern on the 30-year here. And let me bust this up so you can see what's going on. So these are TradeStation symbols, TNX.X, the TYX.X, and the FVX.X. These are the rates. These are the US government bond interest rates. They're actually multiplied by a factor of 10. I don't know why they do that, but they do. So this is a 2.381 percentage interest rate on the 10-year Treasury notes. Now these things have obviously been in a massive decline for about 35 years. And when we're in uptrends, we tend to bounce off supports and break through resistances on the way up. On the way down, we break through supports and bounce off resistances. So we're bouncing off a resistance, breaking through a support, bouncing off resistance, breaking through a support. When the trend changes, we tend to bounce off supports in an uptrend and break through resistances because the momentum is traveling to the upside. And that's what the trending system using the better sine wave indicator is all about. So on this monthly chart, you can see on the way down, most of the time, clean bounces off resistance. Yeah, kind of overshot in a couple of places, but then we got our mojo going on the downside, and we've kept on moving down. And I think the low that we hit in last year down here was 1.336. We had another low back here in 2012. That was 1.394. So very close. It's almost like a double bottom going on there. But as I said, about 4 years between drinks here down at the bottom. So that was 2012. This was 2016. So it's been a 4-year process testing that bottom down there at 1.5. And now what's interesting is most of the time when we've got, in a strong downtrend or in a downtrend, you kind of make your way to your support level, with not much fuss kind of going on. However, we are kind of mid-cycle here, and that's as far as we've decided to go. We've kind of reached a low here of just above 2%, 2.034, and we're up. We're up 30 basis points to 2.381%, and we're very close to this resistance line. Now, a break above resistance would signal strength and a potential change in trend for this entire thing. And that's why I kind of say, well, this might be kind of seminal, because we're talking about a change in trend that has been in place for 35 years, since 1981, I think the peak was kind of up here. So, and this has been, so important. I mean, you've got the same picture in the 30-year. We don't have quite as much kind of history on this chart. Actually, I can go back further than that. Just put in 90. It doesn't go back 90, but there we go. We go back to the 70s for this chart. Same type of picture for the 5-year. But seminal because, if we've got a change in trends into higher rates instead of, the downtrend being kind of broken, we reverse and start to have higher rates, that is seminal. That'll mean, this 35-year trend is no longer, it is finished. And that would be pretty damned important, because when you kind of look back, I'm always looking back and thinking, if I had my wits about me back in 79, 80, 81, what would have been the best investment to hold for the next 35 years? And it probably would have been property. You'd have bought property then, and you'd kept on leveraging up and buying more and more property over that time period because of this phenomenon. So this is this 10-year rates maxing out in 1981 up at, I think, what was the max? I can't quite see it on the chart there, but we're up at 16% in terms of a government bond interest rate. I mean, that would have been fabulous to hold. It's like for 30 years, you buy a 30-year bond netting you 18% year after year. That's pretty sweet. You wouldn't want to be doing that today, buying government bonds that are yielding less than 2%. That would be pretty silly, I would suggest. But this whole trend has affected everything that has happened to our economies in the last 35 years. It has led to the financialization of pretty much everything, with lower and lower interest rates coming as they do. So it's encouraged more and more debt to be generated and held, and money is debt, debt is money. So that's increasing the amount of notes in circulation that are held, and it's not as if your property actually went up in value, but maybe it's just that the value of money went down. And so a house is still a house, but what a dollar used to buy 35 years ago is vastly different than what it buys today. So the value of money has changed because of this interest rate decline. And it's led to more and more people taking on more debt at greater levels of leverage, particularly in the property market. I've talked about this before, where back in the 70s, you'd be lucky to get 50, 60% LVRs most of the time. You had to put down 30, 40% money down, and then the bank would help you with the rest. These days, you actually have instances of 5, 0% down, and in some cases, actually, if you're going to do a renovation or something like that, where you can kind of justify a valuation, negative money down. So there's some, we've gone from one extreme to the other. The other thing that's happened during this kind of seminal decline has been, the impact of baby boomers on the whole scenario, where baby boomers came into their maximum years of financial kind of contribution. They all got older and got richer and hit peak salary, and all of that became disposable income as more of them kind of reached that level, and that's been a huge growth factor in the economy, kind of driving the economy. and we've all become socialists. We have become Russia. That's try and convince yourself that you live in a representative democracy with capitalism and laissez-faire economics. No, no, no. We're in a command economy where everybody kind of lives off the state. Taxes are up to 40, 50% of income. We've become Russians, we've become Chinese, and meanwhile, the extraordinary thing is that the Chinese and the Russians have become capitalists, and they're more capitalist than the capitalists than the West is, which is just an extraordinary state of mind. But the man in the street can't be convinced of that. He thinks that we're all corporatist and capitalists and laissez-faire economics, and that's not the case. We have become socialists, and this entire trend may change. And so when I put myself in the shoes of someone in the early 1980s and saying, actually, the scary thing to do is to buy property with interest rates, retail interest rates were approaching 18, 19, 20%, kind of up at these times to buy property then, an incredibly scary proposition. And I think people who did that took a couple of chunks, couple of bites at it, because they may have got washed out of their property purchase in the first 2 or 3 times as mortgages became too expensive, and they kind of had to sell and walk away and start again. But over a 35-year period, it was the smart thing to do, and to keep building on that strategy in the entire time. So I think of myself today and say, well, what's the equivalent trade? What's the trade that's the reverse of that? What are we going to look back from in 35 years' time and say, hey, in 2010 to 2015, that was the right time to be doing what, X, Y, Z? And I think one of those things is cryptocurrencies, and there'll be a lot of people that say I'm an idiot for saying such a thing, but that's one potential thing that people could look back from in 35 years' time and say, yeah, that was damned obvious. It was as obvious as the internet, So that's one particular trade. But the other things that are going to be happening from now on is, we've reached this kind of peak debt and low interest rates, and that's a very unsustainable scenario if rates start bottomed and start to move up, because we'll get some kind of bust in debt. And as Martin Armstrong likes to say, the problem is not in the equities market, it's in the bond market. And damn right. So we've got a huge exposure to incredibly low rates and negative rates in Europe. And all the pension funds are based on that, and all the governments have forced their central banks to eat the debt. And how will that kind of play out? The reverse of the baby boomers kind of all retiring and starting to die off is we've got a demographic bust. Back in the day we used to have, what was it, 8, 9, maybe up to 10, 11 workers per retired person when we were starting to plan our pension system. And we're at the opposite end of that cycle now. We're down at 3, 4 working people per retired person. So those whole economics have switched around and gone the other way, and we've got a very moribund kind of youth demographic where there's not a great deal of growth happening in youth. It's particularly pronounced in Europe. The US is okay, India is great, China's not so good, Italy is lousy, Spain is lousy. So all of those problems, demographic bust problems, are going to come to the fore potentially with the. So you put these two together in the pension crisis that's kind of going on, and then the last thing is death of socialism. It's taking a long time, and the government's reaction to how to fund services has been extraordinary with the amount of debt, and no one's going to pay the debt off. I've come to that realization that used to really bug me 10 years ago. Well, what are we going to do? We've got to pay the debt off. Got to pay the debt off. No, we don't. They're just going to eat it. It's going to sit on the central bank balance sheet, roll off as it matures, and they're not going to have to deal with that. And so we'll be left with some kind of level of government kind of debt, and we'll just have deficit spending to the end of time. But in some format, this socialism that we're kind of living through, that we've gotten used to, will have to stop and will have to end. So no, it's very depressing little monologue here. I apologize for that. It's a blustery old weekend here in Biarritz, France, and we had great weather for the last 3 weeks, great surf, and maybe it's the change in weather that's kind of gotten me down. But this change in trend is important, and it's taken 4 years to kind of roll around, and we have this first instance of a potential breakout into an uptrend in rates. And where is that going to go, and where is that going to end? Is this the beginning of, again, another 35-year trend in the opposite direction? Now, who's to say that it's going to go back to these kind of levels? We don't need anything near that in order to cause pain in the financial markets because we are overloaded with debt. So just even a doubling of rates from 2.5% to 5%, which would be called kind of normalization, if you like, would cause an enormous stress on the system. So where this goes and what levels this kind of goes to, who knows? But it'll change everything, because all of a sudden this has been very good to us for 35 years in terms of making it easier for governments to fund, people to have assets that go up in value all the time, and us to feel good about our income, because we're just, rather than making money in a job in a real way, we're kind of been funding our spending through increasing debt. So where this goes, who knows? But I think this weekend and that kind of price print this week, and if we get above this resistance on the 10-year, which is at 2.6, then things are going to get very, very interesting. Now you might say, well, surely the problem's not in the bond market, it's in the equities market. Everybody's talking about the massive valuations in the equities market. Yeah, and I agree, we are definitely up there. New highs being broken out every week, every month. And maybe, as Martin Armstrong's saying, we're playing out in this kind of vertical market, and it just takes off, and none of us can explain the valuations, and it just gets out of control. This is the chart I look at to see if there's a problem happening in the equities market, because when I've done my research kind of going back over the years, the problems in the equities market will pop up with people moving from the equities market, taking the chips off the table, and moving the money into bonds instead. And so the crashes in the equities markets are preceded by several solid months of lower rates in bonds as people buy bonds. So people are selling their equities, buying bonds, and rates therefore go down. Bonds go up, rates go down. So if we've got a scenario where the rates are breaking up and going higher, that's people not taking profits in the equities market and getting set for a crash. And so this is the chart that I use to do that analysis. So obviously we've got the equities index. This is the S&P 500 here, and this is TNX.X, which is the 10-year interest rates. And I use my bond oscillator, and this I use for a whole bunch of stuff. You can use it for bonds versus equities. I use it for the yen carry trade as well, looking at price of yen versus the equities market as well. And as long as we're above the zero line here, it plots on the paint bar version red paint bars, and if it's below the zero line, it paints white. And what you can see leading up to all these crashes, so the crashes that we had, crashes defined as a 20% down move in the equities market, you can see in all of these instances that we'd peaked out with this oscillator and then started to break through the zero line. So in the 08 kind of crash, you can see we kept on moving up and up, but we got weaker and weaker on this oscillator until eventually we crossed the zero line and then kept on going. And that was the signal that rates were going down and the equities market was going up, and there was something going on, so that they were moving their money out of equities and into bonds. And so as soon as we have that situation, that's just a warning that potentially the equities market is at risk. But what you can see at the moment with the readings that we've got is that the equities market is going up nicely, and now rates have been going up. So this is kind of keeping elevated. It's not weakening and going towards the zero line or crossing the zero line at all. As soon as it starts to do that, then I'd start to say, well, I'm a bit worried about the equities market. But given this scenario, with rates moving up, equities moving up, I'm actually worried about the bond market. And then so you can see the price moves in the better indicators and see what's going on here. So this is the 30-year. Let you show you this in kind of the detail using better momentum. So here's our peak back in 2016 with exhaustion buy, bearish divergence, end of trends kind of going off here. And we had this huge crackdown. This was the election. This is Mr. Trump kind of getting in. And all of a sudden we had a break in the bond market. And that leveled off at the beginning of this year, and we've been playing back. Now, having had exhaustion by bearish divergence, we bounced off end of trends in 2 time frames and a support on the highest time frame, and we broke back up. And what we did is we went back and tested this level where we broke down at the election, and now we're at the bottom of that whole sequence down here. So this blue professional bar over the course of that day and a half that we had the bond market sell off, we've tested that entire range over the last 2 or 3 months here. And this has meant that we've come into resistance on the highest time frame, on the intermediate time frame. We've had a little bit of short covering rally, bearish divergence, flush here, but all we've been doing is kind of just floating back up to test into this kind of important area. I mean, that whole area was a left shoulder, was a head move, and then was the breakdown of this right shoulder here, and we've just tested back into that area. And what you see on the system view, so there's the system view where we had strength, uptrends, we broke into a downtrend, and we've been in kind of a complex correction on the way up. And now what we had over the last few days is weakness as we're breaking through support. And we've actually, I think on the 10-year, we've got a low risk entry point kind of popped up here. And we're back at the bottom of that channel. If we break Monday, Tuesday, that support, 151, 630 seconds, then that's going to be really significant, because that means that rates are going up and the bond market is really starting to pick up on the downside. So that's the 30-year chart. No, it's... beg your pardon, I thought one of these had a low risk entry point kind of come in. But anyway, so we've broken 1 time frame on the 30-year chart. On the 10-year, same pattern, same kind of explanation, but here on Friday's trade, we broke that intermediate time frame. So we got 2 time frames broken at the moment here. So that's not good. So that's kind of getting the downtrend. We've had our little rally during 2017, bang. Now we've fallen out of bed and we're starting to break supports, and that's not kind of good. And the same picture on the 5-year. So again, 2 time frames, supports on the lowest and intermediate time frames broken down here, and that's all happening underneath resistance on the highest time frame. So that's not good for kind of the bond market. So looking for fireworks in the bond market over the next couple of weeks. Interestingly, commitment of traders also came up with a bearish divergence here pattern. So again, this is interesting. Sometimes some of these signals are absolute doozies. So for example, let me show you the euro. Here was a beautiful signal here. Top of the euro, bearish divergence comes in, bang, falls off, tests 110, bullish divergence, and we've had a rally in the euro. Some of these signals are brilliant. The Aussie dollar one was pretty good, I think. Yeah, there we go. Look at that. Look at the high. Bearish divergence, bang, we fall off. Bullish divergence comes in, commitment of traders, and we start to rally in the Aussie dollar. So some of these are really good, but I don't use them all the time. But it's just interesting in the last couple of weeks that the bearish divergence signals went off on the commitment of traders numbers for the 30-year bonds. Some of these signals have been good, not so good. Okay. Better, good, pretty lousy, not very usable at all. But this one kind of popped up this last week. So just kind of keep that in the back of your head. Then lastly, how to play it. And I always get a bit of kind of hate mail, not hate mail, that's overdoing it. People email me saying, be very, very careful with leveraged ETFs. And I get it. If you don't understand the problems with leveraged ETFs, then do a Google search and have a read, because it can be scary stuff. But if you want to be aggressive and kind of get into a shorting the bond market with a triple leveraged ETF, TMV is one potentially to look at. So this will be the inverse of the the 30-year kind of chart or any of those bond market charts. And so we bottomed out. This is 2016, exhaustion, sell, bullish divergence, and we have the first rush. And we've come back to test into those levels. Again, exhaustion, sell, bullish divergence comes in, end of trend on the highest time frame, end of trend on the lowest time frame here. We've broken into strength, and here we go. This is the low risk entry point I was thinking of. So Friday's trade, low risk entry point kind of comes in. That happens to be an end of trend on the lowest time frame. So we got strength going on here. Thursday, Friday's activity, bang, we had a strong break in TMB. So getting above 1985 as resistance there would show that TMB is looking very kind of interesting for a move to the upside. So that's a triple short on the US bond market. And is it interesting on this chart? This is with all the better pro-am and momentum patterns. So there's our exhaustion, sell, bullish, divergent patterns come in here. And there was the smart money, the pros, getting in there on Thursday, bang, bid it up to just under 19, and then kind of gap up on Friday's trade. So there we go. Bonds, I think they're kind of interesting. Again, I'll link below this video to the 2 or 3 other times I've spoken about the bond market. And as I say, it's like this whole reversal of rates has been a 4-year exercise in kind of finding a bottom, testing a bottom, and now potentially breaking into an uptrend here. So let's see how this goes. But I think this weekend's charts on bonds are going to turn out to be pretty important. Anyway, hope your trading is going well.